Welcome to the big picture, where we talk about micro markets as well as macro markets. Today, I have with me, of course, my co-host, David Brickell. David, how's it going?
Yeah, good man.
And Joe Cruy. And I said that right, didn't I?
Yeah.
I've been.
It's like we're actually coworkers now, right? You can
Yeah.
actually pronounce my name.
It's like we actually know each other.
It's only been what, 2 months?
Yeah, exactly.
Joe, when I first just saw you just now, I thought you were in a robe. You look like you're wearing a white robe.
So too.
I thought you've been on so many holidays. I thought
just got out of the
spa.
Call them out.
Joe's at the spa.
Yeah, exactly.
Must be nice.
And we also have with us two amazing guests from Amberdata. So actually, Greg, you've already been on the show, but could you give us, your brief background again for people who might not have seen the first one?
Yeah, totally. So my name is Greg Magadini. My background is as a proprietary trader. I've been trading for about 13 years. I got into crypto around 2013 and then bought the top at $1,000 Bitcoin and rode it all the way down. Fun experience. And then traded crypto kind of full time and started in 2015, 2016, and then co-founded Gvol in January 2020 with my co-founder, Pat Doyle.
Cool. Perfect. And Fabio?
Yeah, I'm Fabio Bassani. In Twitter, Gravity Sucks, an account that maybe you know. And I have background in economics and statistics, and I always been passionate about finance and trading. Even if at my start in career, I was in another sector. In 2013, with a friend, we bought our first Bitcoin. And my friend was a libertarian. I was libertarian. We studied a lot at the Austrian School of Economics. So we approached Bitcoin from that point of view. And later on, we were passionate about trading options. And together we started to trading at university. He was working at the university at that time. And then in 2019, I did the big leap. I quit my corporate job. I've become a full-time trader. In 2021, in 2021, 2020, I met Anand Gomez that introduced me also Greg, and we started our collaboration since then. So I'm really happy and satisfied to be here after my life, not straight to arrive here, but happy to be here.
That's amazing. That's amazing.
That's so cool. Joe, I didn't realize you were Gravity Sucks. I replied to you earlier. You posted up the massive Bitcoin structure that went through on Paradigm earlier, and I replied to you. I didn't realize that was you. There you go.
Wow, I just learned that now too. Like we had chatted in like DMs. I thought this Gravity Sucks guy was just some some random dude that was active in the market. I didn't know it was. I was talking to this person that I've had extensive conversations with already.
I was very private with my account, but now with Greg, with all the Amberdata stuff, I disclosure my account, and here we go.
Yeah, so I think I've been talking to you since, we've kind of somewhat interacted since you started Gravity Sucks, because I'm Variant Research on Twitter, so we've had interactions for a while, but so it's kind of it's nice to meet you in person.
Yeah.
It's kind of cool that way. Like, crypto is cool that way. I've been at different like crypto events, and you meet people that you've talked to for years, but you just don't know because
exactly
everyone's kind of anonymous, for the most part. But yeah, I guess why we're here is because you guys wrote this report, and everyone's been really fascinated by it. Nand actually texted me right away and was like, "We gotta have Greg back on to talk about this report that they just put out." So Greg, I guess you could start us off probably and share your screen, walk us through this report and kind of what you guys found out through this research.
Yeah, absolutely. I just want to give a shout out to these other co-authors. So Tony Stewart, obviously, who does the Deribit Insights for Deribit. Tony's been an advisor for, I think, like 18 months now. He's been a total G. He's been great. Fabio and Tony are always like analyzing flow. We have this internal direction, and they're always auditing their flow together to make sure that our directions are properly tagged. So that's very cool. Samneet Chapal from Ledger Prime. He's been an OG contact since the early days of GVol. And so it's been great to work with him. He did all the back tests for the back tested strategies here. And obviously the man who needs no introduction, which is Ewan Sinclair, who actually is my neighbor in Chicago. I had no idea until he became an advisor and he signed the paperwork and I saw his address. I was like, oh man, we live like 5 minutes away from each other. So that's pretty cool. And he's been super great, completely engaged and huge help as an advisor. So this is the report that we did. So basically kind of broad overview. We have 4 years of data. We started collecting data in April 2019. So we have April 2019 all the way to the end of the year 2022. And we analyzed specifically just Bitcoin. And the idea there is that customers everything's pre-built in notebooks, can analyze Ethereum pretty easy. But essentially what we wanted to see are volatility regimes and ways to categorize all that stuff. So a lot of these methods, actually Fabio did a really good job kind of figuring stuff out. But I'm happy to just kind of jump any direction that you guys want, or I'm happy to just kind of lead it.
Yeah, I mean, maybe.
I mean, I guess we could do it where, I've read the report extensively, and I thought there was a few charts that were interesting, and maybe we can talk about those ones specifically, and then we can kind of have a discussion about them.
Yeah, totally.
Okay.
Which ones?
Cool. So, do you want me to just share my screen over you?
Yeah.
And don't worry, we'll cut all this out.
Greg, can you give us like kind of like a high level of the report before we like dig in? Just give us like the main ideas, like give us the TLDR basically.
Yeah, totally. Cool. Okay, so too long didn't read version of this report. Please read it. No, I'm just kidding. Yeah. Too long didn't read. Okay, so one of the things that we want to touch on, so I'm just looking at table of contents here. So we wanted to really categorize volatility regimes. So one of the things that we wanted to look at, and this is very interesting for crypto vol. So crypto vol, in my opinion, hasn't been figured out yet. Sometimes it looks like equity vol, sometimes it looks like commodity vol. So one of the things that we looked at in terms of regimes were a contango term structure versus a backwardated term structure. That's sort of the spine of the volatility surface, you could say. Then we wanted to look at the skew profile. So we look at the risk reversal skew. So pretty much the call, 25 delta call minus 25 delta put. So something that's really interesting there is that, if you think of natural gas just like explodes higher or no one cares about it. And so that's kind of like a call risk reversal skew is positive. And then equity index especially is the opposite. Markets crash quickly, they rise slowly. There's a little bit of, correlation impacts there in the index as well. And so what we wanted to do there is we wanted to just kind of categorize, how does Bitcoin trade? Does it trade like a commodity? Does it trade like an equity? So we did a little bit of that. And so those are going to be the term structure, spot vol dynamics, the risk reversal skew. Another thing we wanted to look at is the variance risk premium. So what we did there is we could see, okay, are options overall cheap or are they overpriced? And then does it matter if we overlay different filters? So like, is risk reversal, or excuse me, the variance risk premium, is it expensive if we're in contango versus backwardated? Or if we're in a positive risk reversal environment versus a negative risk reversal environment? Or maybe if we layer the two and see what kind of differences there are there. So one of the charts that you'll see come up a lot, let me just give you an example, is going to be these box plot charts. So the idea here is we can see the middle line is going to be the median within the box. And then you have the interquartile, and then you sort of have the extremes. And so the idea there is you can get like a probability distribution of the observations or a distribution of the observations. So that's kind of like the high level. We did touch on a few things like the futures basis, which was, very quiet in 2022. I know that Paradigm's like doing huge like leaps and bounds to facilitate this type of trading, which has been like an interesting vehicle to trade the future spreads. So that's going to be really interesting. And then we just touched on some volume and some open interest metrics as well, where we saw 2022 with a lot of block volume on Ethereum. So, Paradigm, obviously, all the block volume goes through you guys. So that was like another interesting point that we wanted to kind of touch on.
Cool. Okay. Yeah. Joe.
All right. Awesome. Yeah. I'll share my screen, and a lot of the things that you just mentioned we're going to be talking about. So let me just do that quickly. Yeah. I guess just to start out, really like the piece. I'd classify this. I worked at Deutsche on their equity derivatives desk, and JP Morgan on their equity derivative desk. And like, this is probably like the most comprehensive crypto volatility research that's currently on the market, and certainly on par with, the top derivative research pieces that I saw that I've seen from the investment banks. So like, kudos to you for really starting to build this out. But I guess two of the vol parameter charts that really resonated with me was the new term structure richness chart that you guys recently released, Amberdata. I think it was, you released it like a couple weeks ago, or maybe this was the debut of it. So that chart, and then as well as, the box plots that you were talking about, the 25 delta skew, and how has that evolved since the crypto option markets really caught steam in 2019, due to different regimes in spot vol correlation, right? So, starting with the term structure richness chart, like, why should investors be looking at term structure richness when examining crypto vol markets? Like, what was the thought process about like adding this new cool and sleek chart into the Amberdata?
Yeah, absolutely. So Fabio, I'll loop you in on this because this is something that Fabio and I devised, and we kind of went back and forth on some of the stuff we wanted to include. So maybe if you want to talk about sort of briefly the methodology.
Yeah, maybe I can introduce the methodology of the richness of the term structure, and then we can, with Greg, take an overview about the result. Basically, what Greg and me thought at the start of the report about the quantitative measure of the term structure, because usually we know as a trader that a term structure is backward dated or in contango, because the front is upward or downward according to the end part of the term structure. But we wanted to measure quantitatively the slope of the term structure. So we basically developed an easy method to calculate every difference across the term structure between maturities, and then we calculate the average ratio. And the average ratio is the result of this chart. Basically, when we have values above 1, meaning that the term structure, the overall term structure is in backward dated, and values below 1, the overall term structure is in contango. So it's important to define a methodology just to measure, and because from that specific methodology, afterwards we calculate everything from the box plot according to the term structure of the backwardation of contango. So it was a very interesting part with Greg to develop this approach, because I think it's quite unique. I think in a crypto space, but I don't know. Maybe in TradFi is something that is usual. I don't know. And yeah, the result is pretty constant through the time series. So it's
right. So just to summarize, you're effectively looking at the term structure and calculating the first derivative of the term structure at multiple points across the curve. Are you using a weighted average to do it, just because, at the front of the term structure, it's going to exhibit more steepness compared to the back where there's not going to be as much? Or are you guys just taking a mean average?
No, a mean average, but we calculated every combination across the maturities. So,
I see.
For example, the 7 days constant, we compare it to the 30 days, the 60 days, the 90 days, and the 180. We did the same with the 30 and so on. And so we averaged everything. And so basically it's quite weighted, even if the methodology is
that makes sense. So you effectively just have a matrix of these averages for each point. That makes sense. Cool. Well, on first glance, I mean, you look at this chart, right? Like, what the heck's happening here, right? Like, it seems like when you kind of first look at these charts, like, dislocations are a pretty funny thing in the vol world. And when you look at it, it's like, oh, damn, like this is a significant dislocation and it has to mean revert because every time it's gone down to this level, it has in the past. But like, I don't know, I guess like given the vol regime that we're in, this is kind of the behavior you would sort of expect, right? We've been in a lower volatility regime as of late, especially in Q4 when this data was compiled. As you can see in the chart, it doesn't capture any of the Q1 data, but absolute level of implieds are relatively low. Realized was even lower, right? You have the significant roll down effect, similar to an equity vol that you'd have. But on the back end, there is still some of this expectation, that you could have this potential large spot move just because of what happened throughout 2022. Like we had 3 black swan events, and perhaps that's the reason. Like even when the front end was trading in the 30s, right? You still had that back end still trading like in the 60s, right? So like given that low vol regime of Q4, I would expect the term structure to be steep. But that being said, we have been seeing a lot of guys on Paradigm kind of been taking advantage of the steepness by selling a lot of these front end calendars and collecting this roll down. So like, would you agree? Like this is kind of like the behavior you would sort of expect in a vol regime like this. And I also think it would be interesting to kind of look at this. I think you do this at other points in the report, kind of looking at the steepness across different vol regimes, right? Like, because, when vol is really low, you expect term structure to be steep. When at the money implieds are high, you would expect them to be backwardated. So like, would you guys like look at like kind of normalizing it as well, similarly to how you guys have like normalized skew charts on Amberdata?
Yeah, that's a great point. So one of the things that we did is we worked with ratios in order to account for that. So that was actually an advice tip from Yuan when he double checked our methods. But yeah, we couldn't just do absolute values because different vol regimes are gonna be way different, and so you don't want to have a steepness that's affected by the overall level of the vol. So that's definitely something we kept in mind. As far as kind of your broader point question, and Fabio, feel free if you want to jump in at any point. But if we're talking about sort of, where we are or where we were at the end of 2023. So one of the things that I always try to keep in mind, or one of my assumptions, is that structurally, I think crypto vol has to go down in the long term. The asset becomes more efficient. The market caps grow. A lot of the surprises that, the government says it's not allowed. Now it says it's allowed. Those have less and less impact. The 10th time to do that, or the 11th time. There's more adoption across the globe and stuff like that. So my base assumption is that we structurally will have less vol. And so that's one point of it. The other point of it is when we're looking at steepness, I always think about this for anyone who's traded equity vol, VXX trading in 2017. Like the decay from the roll down on the VIX cash versus the front month future and the second month future is so steep that was like the best trade ever. Now, I wanted to quantify something similar in crypto vol where we could see, okay, like where's the cost of carry in terms of vol roll down the most expensive, and if you're wrong, like where does it peak at? And so those were sort of the more interesting points in my opinion. And obviously we saw this in Q4 a lot. Like this was decade low vol in realized terms and really steep decay down the structure. So that was something that was pretty interesting. And obviously Q1 2023 is a big kind of difference from Q4 2022.
Cool. Yeah, that makes sense. And I guess we can leave the term structure and kind of just moving on to the skew. As someone that I wasn't active in this market, back in 2019 or 2020. So it was super interesting to see how this skew has evolved over time, where, like you said, it's like, okay, it's kind of trading like, skew is much more flat, kind of like a commodity or like, nat gas. But then you have a year like 2022 when, the skew looks a lot more like equities. Like anecdotally, I think you guys will enjoy this. I used to always wonder, why GVol decided to calculate skew as calls minus puts. Because when I entered this market, I'm like, in 2022, I'm constantly looking at this negative number, and it's like not intuitive. Like, why did they decide to do calls minus puts? No offense. But then I look at this data, right? And it becomes clear that in like 2021, all the most significant outliers in the skew have been in favor of the calls versus the puts, right? So now I see why you guys decided to make that decision. And it's really only was until this past year that the 25 delta puts traded at a premium, compared to the calls. And I think you mentioned in the report, there was like a time when the 25 delta puts were trading the same vol as the at the money vol. Like, that's insane, right?
Exactly.
It's insane to think about when you have years like 2022, when you have all these sort of events. And we've definitely seen some skew selling, via BTC riskies to play for this reversion back to the, 2022 regime of puts over calls. But, in BTC, the skew has kind of been rather sticky as of late to start 2023. I think the calls are still trading a couple vols over the puts. I mean, of course, it was, at extremes a couple weeks ago. I think it was the 1 month 25 delta was trading like 8 vols over or something like this. And now it's only 2 vols over. But you could argue that it's kind of a bullish sign for the market, right? It's very clear, as we had mentioned, from our previous episodes, that, our client base is significantly positioning for the rally. And we've really seen the significant upside realized vol as of late. So like, what sort of like skew regime? I know it's a loaded question. Like, are we kind of entering in 2023? Like, in 2022, it traded like equities, but now you're seeing all this sort of like upside realized explosion, like you guys mentioned, in nat gas. Like, what do you guys think is going to happen?
Yeah, that's a great point. So first off, I want to say kudos to David, because he totally called decompression of yields, the macro picture easing, and like a massive rally. And here I am owning puts like an idiot. But that being said, so a couple of things that I think are really, really interesting. So as far as like as far as the skew goes, call minus put, that's been a hot button issue within the GVol world. I always thought I was more
Joe, I have to say, every day when I go on it, I just always flip it. And it's just like, let's quickly change that. Even I don't know why, I just find it easier to read the other way. But
yeah, I think everyone from the TradFi equity space like loves the put minus call, but I don't know, from commodities, this just makes more sense to me. But anyways, so one of the things that's really interesting right now is that, okay, why is it trading positive now, especially in the long dated? Short dated skew can do whatever it wants, because short dated can move short-term stuff can happen in any direction. If we're looking at 6 months skew, we're still trading a couple of vols to the call side, like a couple of vols positive. So to me, that's really interesting. And I think this is where there's a potential opportunity, because I think there's a potential dislocation between implied and realized. So on the implied side, let's just say that, miners have gone bankrupt or reduced their business. A lot of people who are just, buy holding crypto and selling calls as passive income, are maybe out of the market. DOVs have reduced volume, stuff like that. So there's an argument to be made that like the supply of call selling has come off the table, and therefore the price of calls has gone up because there's just less downward pressure from supply. So there's that argument. And then there's the argument of like, well, what's really going to happen with a realized spot vol regime? Has spot vol changed because the first month of 2023 has been bullish? Like that, to me, that's kind of a hard leap to make. So one of the things that I think is really interesting is that if Bitcoin and equities are highly correlated, and equities has kind of a negative risk reversal skew, and Bitcoin has a positive risk reversal skew, well, then you can just like mirror those assets and trade risk reversals kind of against each other, and that gets like that's becomes really interesting. So to me, I don't know if this is sustainable. Like I don't know if we've completely switched from a negative spot vol regime to a positive spot vol regime. 6 months out, like I'm skeptical of that. 1 month in, like that's cool. Like short dated stuff, no opinion. Long dated stuff, I kind of think like this is a fade. But I don't know, Fabio, how do you feel?
Yeah, I was thinking about the early months of 2021 when we had that explosive upside positive spot vol correlation because the Bitcoin break the previous all-time high from 16 to 30 in around 20 days. And in that occasion, we had a short squeeze on ID with IV reached on the call side extreme level. So we have to look at the general picture of the last 3-4 years, separating that first months of 2021, in my opinion, because it was something anomalous, unusual. Of course, in crypto, always have the positive call skew because we had that parabolic move on the upside. So traders positioning itself for with the calls. So usually calls tends to be overpriced against puts. But I agree with Greg that structurally we will see a different approach to the call to the put call skew, and I think the put overpriced overcall will be the normal state of the option space, and it is difficult. It's difficult for trading that entered that space in that years because during the 2021 it was very fun in trading options, even if the volatility was explosive, but it was funny trading options on that period. And now we enter a new regime, maybe where big funds are trading differently, are trading more nuances, trading with blocks. We saw a lot of blocks with futures leg, so meaning that it's a pure volatility trade. And this type of approach tends to be more sophisticated, and it will be more difficult for retail traders to take advantage of the such extreme values in the EV structure. And that's it. But opportunities are there, and we'll see if another parabolic move will occur in the next 2-3 months. We will see again calls priced 20-30 points above skew, above puts.
Yeah. I mean, something we're very curious about too, because it's really interesting. Whenever you start to see, and we touched on this on a previous podcast of crypto spot vol reflexivity, and as soon as the market starts to take off a little bit, we see guys just trying to pile into the calls and engineer this sort of rally, right? So it's happening this, the past couple of weeks where we'd have a big spike up intraday, then somebody comes in and tries to quote tries to lift 500 of 1 week call options to kind of continue that move and that positive feedback loop. So we'll see. I mean, I would love to see it. I mean, it'd be great for the industry to get spot back up to where it is, and certainly make the crypto vol markets more exciting. So
yeah,
it'd be interesting as well to look at it in terms of to kind of look at where people's the distribution of people's price targets are on crypto. So to think about where we are location wise within that, because I'd imagine if you spoke to people now, people tend to go, if we get another sell-off, macro changes, what have you, I don't know, 15K. Whereas if Fed start cutting rates and things materially change, then I don't know, just sticking numbers on it, 35-40K by year end. And it's kind of how the distribution of those sort of views on where Bitcoin trades this year, if you're obviously at the lower end of that, then the chances that you start to see calls trade over puts within that location will be greater. Then obviously you start to move to the middle of that distribution, you start to get to 30K, and then I'd imagine you'd see that flip back towards back to the puts being over calls. But I think that could be quite interesting to look at as well.
Yeah, I'm not sure if Kathy Wood is still I think her price target's still holding at 500K. Like remember back like in Q4 2021 when we were just ripping, like, Bitcoin went through like 65K, then just like everywhere you would just see like these crypto price targets like 200,000 by the end of the year, 500,000. Like, I hear you, but like, I mean, this stuff is just so hard to predict, right? Like the fundamental, like analyzing the actual fundamentals of this, like it kind of seems it's much more around, supply demand imbalance and liquidity that, drives the moves rather than, okay, like I'm actually gonna, do a fundamental equity analysis like DCF or, comparables. So it's just so difficult to like look at these price targets and like be like, what are you basing this on, really? But anyhow, that's my rant there. Okay, so I want to talk about this, the ETH open interest flippening. So you guys mentioned this, right? So in the lead up to the merge, right? We saw all this taker interest, right? People were trading all these call flies, ahead of the merge, really trying to position for this rally, right? There were like hundreds of thousands of contracts that were like attributed to just this like big December call fly position, right? It was like the December, like I think it was 2,500, 3,000, 3,500. There was like 100, don't quote me, but like 100, over 100,000 of these, in the open interest. And then the March 3,500, 4,000, 4,500 were also there, right? So like we did have this flippening, but a lot of it was kind of just attributed to these really wingy option plays that were ahead of the merge. Mm-hmm. And then lo and behold, what happened at the beginning of the year? Or at the end of the year, sorry, the December call fly rolled off the open interest. And then the March structure is going to do the same in a couple months. And what we've seen, per that arrow, is now the open interest has flipped again, but now it's actually in favor of Bitcoin, right? Like all the interest that we've seen from takers in upside plays has mostly been, in Bitcoin. Like there's been some in Ethereum, I'm not discounting that, but like very much more in favor of Bitcoin compared to, Ethereum, where it was just due largely to the presence of a significant catalyst, right? So, do you think this is going to come back? Like my view is like this whole ETH flippening thing, given it was just like all these like really wingy call flies that really didn't even really represent much risk, that drove the Ethereum open interest higher than Bitcoin. Well, those expired, and then now Bitcoin is leading again. So like I'm curious what your guys' view on how that open interest might play out in the future.
So I think this is Fabio and I's favorite topic. So Fabio and I are similar in so many ways. We almost have the same birthday as well. But I'm an ETH maxi and he's a Bitcoin maxi, and we love to just argue about that stuff. So I think we'll both have opinions here. I'm of the opinion, kind of some historical perspective. When I discovered Ethereum back in 2015, I literally sold all my Bitcoin for Ethereum to hold Ethereum. And I couldn't believe not everyone else in the world wasn't doing the same thing. So I'm like hardcore ETH maxi. And so my thinking is like the crypto financial infrastructure, the crypto ecosystem, at the end of the day is still being built on Ethereum. Like think about all the stablecoin growth and how important stablecoins are to the market. And like, I know Tron has some stable coins, but forget Tron for a second. Most of it is built on Ethereum. And so like that's an infrastructure layer. Then if we look at the total market cap of Ethereum plus all the ERC20s built on top of it, like Ethereum's got a lot of presence in the total market cap of the crypto space. And then if we look at all the DeFi innovation, like the fact that Solana it's not disappeared, but like that was a pretty big hit with the FTX stuff. And like, the Sam Bankman-Fried is not a good look for Solana. And so to me, like, ETH's number one killer basically died. And so like we're back to ETH. So I don't know. I think in a long term, from a structural perspective, I still think the flipping is going to happen in terms of options open interest, in terms of market caps, in terms of like the base layer of crypto. But obviously that is just my opinion. Fabio, if you want to chime in.
So great.
This is great. This is This is
Hold
great
on.
clickbait, Greg. Thank you, man.
Yeah, exactly. So, Greg, you're saying you think that ETH's market cap is going to flip Bitcoin's market cap at some point in the future?
Yeah, I think so.
So, Fabio, I'd be interested to hear your take and like, why are you a Bitcoin maxi? I imagine it has something to do with your libertarian views, but
yeah, exactly.
Go ahead.
The story starts then. Yeah, I agree with Greg, but only when he called me a Bitcoin maxi. I don't think Ethereum also in that period pre-merge and since May June 2022. Also, the structure that created that massive open interest in Ethereum was not so. Let me say directionally, it was a very light structures in terms of option, because most of them was, if you remember well, it was a butterfly. So you have those massive contracts to gain small exposure in the Greeks, and small delta, small vega, and so on. So basically, we have also to compare that kind of a structure. We have some matrix to compare that type of structure we see on Ethereum and Bitcoin. One, for example, is the net delta of the open interest. We have it on the platform, and this is one of the reasons we saw that massive upside in the open interest in Ethereum. Of course, there was a lot of interest of the pre-merge. It was a nothing burger at the end, and so a little bit the open interest deflate. But it was a specific event that changed the trend, because I remember well, I looking at the weekly volume between Ethereum and Bitcoin every week, and it's from the FTX collapse that happened the shift. So it seems that in that occasion, a lot of traction for the Bitcoin value proposition. So no counterparty risk, not your keys, not your coin. So all the thematic of the maxis Bitcoiners gain some traction over that collapse. And Ethereum, in my opinion, influenced negatively from all the ecosystem. Is Greg is right, because everything in crypto has built mainly above Ethereum, and that event caused some shift, in my opinion, in the faith about the general decentralized vision about what's it's under the Ethereum ecosystem and vision. So maybe these two aspects influenced the recent events. We constantly seen since then that weekly volumes on Bitcoin are around 50% more than Ethereum volumes. Nothing is changing at the moment, so it's quite difficult, in my opinion, that open interest in the short term. I think in the next 6 months we flip the open interest of Bitcoin, because a lot of structure will have to expire in the next March and June as well. A lot of structure was built during the last June for the next June. So
yeah, exactly. And these are structures that are not going to be rolled given
yeah, exactly.
So so like I definitely agree with aspects of what both of you are saying, like not to be a middleman, but in terms of the short term, I think the open interest is going to be more in favor of Bitcoin, and that's certainly what we've seen already. But then over the long term, yes, I agree with Greg. We're going to kind of have this fundamental shift. This crypto lives on Ethereum, right? So I think we're eventually going to, take off in favor of Ethereum. But I mean, what Fabio, what you were saying in terms of like the open interest, right? Like there wasn't much like actual risk out there, right? Like when you were looking back like August and September, you look at like the open interest, like bell curve, if you will. And then all the open interest was concentrated like 100% higher current spot levels, right?
Exactly.
Did you guys say that on Amberdata? Correct me if I'm wrong. You have like a risk adjusted open interest? Because like, in my opinion, open interest wise, you kind of have to weight it by risk, right? Like a Ethereum March 4,500 call doesn't mean like anything to me. Sure, like a contract's a contract, but is there anything on Amberdata where you guys are weighting the open interest by, delta or some other risk measure?
We do have a view that shows like outstanding net delta across strikes and stuff like that. Mm-hmm. But yeah, that's an interesting perspective. I get what you're saying. Like a package structure is like 4 times the contracts and like a tenth of the risk. So there's definitely something there that could be sort of misleading from pure outright open interest.
Right.
Just something just to sort of weigh in, I guess, from the macro on some of this. One of the things with list flipping with Bitcoin, open interest, flipping ETH again, I think that's kind of reflective of what's been driving this move to start the year. And I think that's, again, this kind of macro regime shift that I've been talking about. And Bitcoin's like the pure play on that, right? The pure play on monetary policy. And you're seeing it even with Boomer Gold, right? Even that's performing pretty well to start the year. And I kind of feel that right now, that's the trade that's being played. It's this, we're changing into this environment of Fed hikes to now the pause and this kind of changing monetary environment. I kind of think that's why maybe Bitcoin's kind of taken the sort of focus and where investors are looking to place risk. I think as time goes on, again, time frames is difficult, and like you say, we've got this stuff rolling off in March and then June. But I think once we get a little bit more settled in that trend, then we start to look at more like idiosyncratic factors within the crypto space. Obviously, we've got the Shanghai upgrade coming in March. Be interesting to see if people want to play that. But I kind of think even, one of the charts I keep looking at is obviously the burn rate with Ethereum and going deflationary now. Where we start to then start to play those stories, and then the interest comes back in Ethereum and open interest starts to pick up again as it becomes less of a monetary story, now back to network effects and all these idiosyncratic stories focus around the crypto space.
Yeah, it definitely seems to me that ETHOI is driven by crypto-specific events. But the other thing I was going to say was, kind of off topic, I think we should have another podcast just between Fabio and Greg, and we have a debate on who, like, Bitcoin maximalism versus Ethereum maximalism, and we will fight it out to the death to see who's right. But Joe, do you want to move on to the next slide? I think we're
sure.
Time here.
This will be the last one. I'll skip over the BTC stuff. Cool. It's kind of more of the same story. I want to talk about this. I want to talk about systematic vol selling in crypto. Right? It's certainly it's something that we still see quite a bit of on Paradigm, despite some major players in the systematic vol selling community kind of losing their shirts in 2022 with everything that happened. But that being said, I mean, David, you can speak to this, but a lot of the prospecting conversations that I've been hearing from my seat is like, oh, okay, new systematic strangle seller or overwriter looking to sell a slug of Bitcoin options like every Friday. It like, despite all these events that happened last year, it seems like a lot of like the prospecting conversations I'm hearing from David's team has been, systematic vol sellers are still here.
Yeah.
Right. And like, while these strategies, they certainly do back test well, but like at the same time, like, I'm kind of wary to trust, the sort of vol selling back tests. You got to be able to, stomach quite a bit of mark-to-market swings. And additionally, most of these strategies tend to be levered. So like things can go bad very, very, very quickly. And like we used to have guys that would come in and sell like 1 to 3 day BTC strangles, like in clips of like 500, right? And they were doing this, in the run up to Luna, and safe to say those guys that were doing stuff like this are not here anymore, right? But that being said, when you do look at the vol risk premium, like in that report, I don't have it here, kind of hovering in that 10 to 20 vol range. And, granted, Bitcoin, it certainly exhibits more, vol of vol, and it's a higher vol asset. But I can kind of see why people are interested. That being said, it certainly is a pretty dangerous if it's not managed properly. Like we had Gordon on our podcast from last week's Gordon Grant from Genesis, and there was a quote that really resonated with me. He's like, Wall Street's an expensive place to find out who you are, while crypto vol is potentially a fatal place to find out, right? And like, what's your guys' like opinion on systematic vol selling? Is it going to continue to happen? Like, so this chart on the right, actually from QVR, Ben Eifert, if you follow him on Twitter, and it really shows that since 1990s that vol risk premium has significantly compressed, but in crypto it really hasn't happened too much yet. Kind of just looking at your chart, like, you think we're going to continue to see the systematic vol selling? You think that VRP is going to compress over time?
Yeah, that's a great question. Happy to just kind of take a stab at it. I think structurally it has to compress. So when I talked to Ewan about this during our interview, I asked him, is there an argument to be made that as market making gets automated, as the infrastructure around market making eases a lot, there's kind of like a justification for like the cost of labor of delta hedging, and like the ease of sort of hedging your risk makes it cheaper, or you could sell vol at a lower variance risk premium to essentially like still make money. If you can market make on 100 stocks versus 2, it takes a lot less people, therefore you can undercut and so on and so forth. Just like an insurance business, essentially. I mean, State Farm versus Allstate, all that stuff. So I think the nascence of crypto vol probably plays into that. So because there isn't the same infrastructure in crypto vol as there is in equity vol, I think the variance risk premium will be bigger until more and more players come in and start squeezing it. I think that's by definition a structural assumption that's safe to make. As far as this chart goes, like, I don't know, selling straddles systematically is not a trade I would do. It feels a little bit like the day in the life of a turkey chart. It's like everything's great,
it's good until Thanksgiving.
Pennies in front of the steamroller.
Yeah.
So I actually have a question kind of piggybacking off of that. Like for the people who don't like selling vol, will you guys eventually put together a report showing returns of dynamically hedged long vol positions?
Yeah, that's interesting. I'm not opposed to doing some of those back tests, and I'm not against selling vol either, but just not.
Well, not kind of wouldn't it just be this chart just kind of like flipped over the x-axis and then just be a long painful drip down lower and lower?
Yeah, exactly.
I could just see you guys will spend hours sort of doing that report, and then Joe's just going, they've just flipped the chart, man.
Yeah,
exactly. Just add a negative to the y-axis, and you're good.
Yeah. And heuristically, like Joe said, I saw I watched vol sellers close with a bunch of vol sellers over these last like couple of years, and it was pretty painful for them. I mean, they had like massive swings up and down. Eventually, most of them blew up, but yeah, interesting stuff for sure. Joe, do you have anything else you want to say as we're coming up to the end of our...
coming from my TradFi vol seat, like, a thing I'm constantly thinking about is like what is the evolution of the crypto vol market going to look like, and is it going to mirror what has happened in equity options and TradFi generally? And one thing I wonder about, and Fabio, you come from a TradFi background, right? Like, as the crypto vol market like gets more developed, and maybe like hedging risk via like QIS strategies becomes more prevalent, right? So what I mean by that is like QIS being like systematic and quantitative strategies that are packaged in like a node or like total return swap format as like either yield enhancement risk premia or hedging overlays, right? So like, for example, I used to do like some QIS business in my previous life, and we used to facilitate tail hedging strategies for systematic vol selling asset managers like oh, let's like overlay your systematic vol selling portfolio with delta hedge 1x2, sell 30 delta, buy 10 deltas. And, the hope is that, if we get a sell off, the money that you're going to make from your Vega exposure as you approach the 10 delta strike offsets the amount that you lose on your 30 delta, and then the fixed strike vols on the downside move up, right? So we were doing like trades like that, and intraday trend strategies, basically just as overlays for asset managers for these like sort of vol selling programs. Like I still think the market's a little bit too nascent, but that OTC market is developing, and I would imagine that this is like these pre-packaged sort of strategies that you're seeing coming out of like SocGen's really big in these, for example, or a BNP is eventually going to work its way into crypto for people that are systematically selling vol that are having difficulty managing some of that tail risk.
Greg?
Sorry.
So tough question.
Sorry. Like, what's the question?
Like, if you think we're going to see like eventually more of kind of like the QIS stuff, appear in crypto vol. Like, I mean, if we don't have like a good response for this, we'll just cut out this part.
Yeah, I mean, to me, I kind of stick to the earlier statement. Like, to me, it's all part of like expanding infrastructure, and like once there's more infrastructure, there's more vol plays. Kind of touching earlier on the skew as well. It's like once we have the return of people who are just doing the systematic selling, even just the covered calls, like that affected, to me, that affects the skew. I could see that have a big impact for sure. And I think people will do those plays, but like here's a kind of another interesting point is that everyone in equity world has infrastructure built around stocks and stuff like that. There isn't good like vol venues in traditional finance for Bitcoin except Bito or CME, but even that. So it's like we don't even have a way to translate, like we don't have a highway from people who do this traditionally into crypto vol yet. We don't have a real highway.
Yeah.
Yeah. And you kind of think like everything in crypto, right, is, we kind of, reflecting some of the evolutionary cycles we saw in TradFi, but just at like moldy speed in the crypto world. So I guess to your question, Joe, like, yeah, you kind of think as more kind of experienced guys, from the TradFi world come into the space, that those products will naturally start to evolve and probably a lot more quickly than they did like in the TradFi space. And one of the other comments I guess I want to make is like what I love about this report is, there's still so much education going on. I talk to funds that, are interested in the space, don't quite understand it. We laughed last week about, you still get questions, are these things trading 10 vols wide? And it's like, no, you can get stuff done in these markets. And I think the more we have reports like this that start to kind of help educate and bring that understanding about, how these markets trade, then it's just gonna add to the adoption and the interest and people coming into the space, which then adds to the drive to get the infrastructure and then the products, and that will follow as well. So like kudos guys for doing stuff like this. Is great.
Yeah,
thank you.
Exactly.
Thanks.
Cool. Yeah. Okay. So either Fabio or Greg, do you have any final thoughts you want to say about the report?
As far as the report goes, our plan is to release a few of these a year. So we'll have one every quarter essentially. And then kind of just a brief thought for customers of ours, like Fabio has taken the time to build all these in Python notebooks that will be available to customers, and then they can do their own tweaks or pass a different symbol, ETH in this case, or instead of writing something from scratch, they can take existing analysis and tweak some parameters. So that we've tried to make it so it's easy for practitioners to use this data right away.
Cool. Well, I want to echo David's sentiment and say thank you for building this stuff out, like offering this research to people for free. I mean, I think it's very valuable to a lot of people. So really cool work you guys are doing. And again, thank you for coming on the show. I think we'll just cut it off here.
Yeah, thank you very much.
Pleasure.
Thanks, everyone.
Cheers, guys.
Really appreciate it.
Thank you.